Good morning, everyone. I'm Barbara Kaufman, Executive Vice President and COO at Newark Regional Business Partnership. Welcome to NRBP's Regional Economic Outlook for 2022. NRBP is connecting business for a greater Newark. We connect, inform, advocate, and engage our members to revitalize the city of Newark. We're committed to providing access to information and to helping you make important connections. In addition to providing program content, we deliver one-on-one assistance through our member care. If you're a member and you want to set up a call, please contact me by email. And if you are not a member, I would like to hear from you as well, so we can discuss how you and your company can benefit from membership. Maya, if you would please put my email in the chat box so everyone has it accessible. We hold this program annually, and until last year, the program took place on one morning with an economic forecast and a single panel. This year, we're capitalizing on the virtual environment and offering quick views of many topics over 2 days. We hope that you will join us tomorrow at the same time to continue conversations about what's trending. We chose this topic because we've seen rapid change in the way we do work and live, influenced by COVID and also by the heightened awareness of the impact of systemic racism and inequalities. The economic recovery has been uneven and job losses remain steepest for Black and Brown women. As the economy recovers, where will benefits be realized? There has been much discussion about the Great Reassessment. We will hear 3 economic reports, one today by NJEDA and 2 tomorrow, New Jersey Department of Labor and Choose New Jersey. Our panels will address many topics, including supply chain, which is on the mind of many industries as they confront shortages in all sorts of products. That will be tomorrow. The logistics for this morning. The audience, all of you, will be off camera and muted for the duration of the program. We have a packed agenda and will not be taking audience questions live. If you have questions, please put them in the Q&A, and we will ask the speakers as soon as they finish their panel to respond to your question. If you don't get your question answered during the program, we'll forward it to the respective speaker and give them the option of getting back to you, and invite them to get back to you. I will be transitioning between all speakers and topics. Please see the chat for the overall program with titles and organizations of the speakers. Now I'd like to thank all of our sponsors for today. The sponsor of the Real Estate Economic and Development Series is TD Bank. More about them in a moment. Breakfast sponsors are Edison Properties, Horizon Blue Cross Blue Shield of New Jersey, Kukin Brothers Company Incorporated, NJEDA, NJIT, Martin Tuckman School of Management, PSEG, Quest Diagnostics, Savills, and Structure Tone. Thanks to our media sponsor, NJ Advanced Media. We could not do our work without the support of our sponsors. We're very grateful to all of them, and I invite you to contact me if you're interested in that opportunity. It's now my pleasure to introduce Scott Barrisword, Vice President and Senior Lending Officer at TD Bank. I'll return after Scott makes brief welcoming comments. Thank you. Scott.
Yes, good morning. Barbara, thank you. As mentioned, TD Bank is the lead sponsor for today's Real Estate Economic and Development Series, actually for the entire series, hosted by the NRBP. And I hope everybody gets a lot out of it. As Barbara mentioned earlier, there's an awful lot going on in the economy. There's an awful lot going on in the world between everything that's happened. But I am pleased to be representing the local TD Bank team led by Market President Martin Malilly, Doug Turnbull, Regional Vice President for the Union and East Essex team, for the Regional Economic 2022 Outlook presentation today. I've had the opportunity to be involved in these presentations over the years and have always gotten a great deal out of them. Over the course of the pandemic, I'm proud to say that TD Bank was actively involved in the PPP loan process. We approved 133,000 loans for over $12.2 billion in funding. And what did that mean? It meant that the bank was committed to helping small businesses across our footprint remain open. These are historically challenging times, and if you don't know much about TD Bank, we do offer a comprehensive suite of products and services to help your business grow, whether it's treasury management, whether it's lending, deposit services, whether it's just to be virtual and online, we can help you with that. We're here to assist you during these troubled and challenging times, which we know have not been easy for any business, whether you're working from home or whether you're back in the office or whether you're transitioning. It's been a challenging 2 years, I guess. So our local teams have a lot of market expertise. You know, we know a lot about Newark. We know a lot about Union and Essex County. We know a lot about the central market of New Jersey, which is really the topic of today's program. So if there's anything that anyone needs, please feel free to reach out to myself. Barbara can provide my contact, or any of my teammates, which I'd be happy to provide to you as well. So I wish everybody the best. I hope everybody enjoys the program today. And you know, I'm very happy that TD continues to support the great programs that Chip and Barbara and of course Maya and the rest of the group are putting on. So enjoy the program today, everybody, because I know I will. Thank you.
Thank you, Scott. And before I begin, I want to also thank Maya Curry, our VP of Communications and DEI. Maya does an incredible job, and without her, we would not all be here today. So thank you to Maya. At the end of the program, Chip Hallock, Nrbp's president and CEO, will make closing comments. It's now my pleasure to begin the program with our economic report by Richard Kasman, the chief economist and director of policy and data analytics at NJEDA. Richard.
Hi, thank you. I'm going to share my screen. So first off, thank you again for having me. I really do appreciate the opportunity to present. I believe this is my third time presenting for NRBP. So today I'm going to be talking about the overall economic landscape, specifically focused on New Jersey. And the title is Some Short-Run Pain, but More Long-Run Prosperity. So just the backdrop, first of all, where is the pain? I think we know a lot of the pain. There's a lot of supply-induced inflation pressures, commodity shortages, and labor shortages that we're all talking about. But the gain that we're seeing is we're seeing a lot of innovation here in New Jersey and a lot of changes in the backdrop of what New Jersey's economy is looking like. The risk right now, I'd say that this transitory inflation that we're seeing becomes more entrenched in labor and other pricing, and that leading to the Fed to react quicker in raising interest rates, and that having a negative impact on the economy. Also, just higher interest rates, potential stock market declines, dollar strength, potential recession. I don't want to say that. I don't really think it's the bottom, the baseline, but when you do have higher inflation and the Fed has to react to it, those are the risks. But I'll also let you know that I don't think that higher inflation ongoing is the main risk. So what are we seeing right now? A little bit of so-called stagflation. Is it 70s style? So everybody likes to compare it to the 1970s. I really don't think so. We are seeing some big increases in food and energy, but overall core inflation, especially here in New Jersey, still actually kind of muted around 2.6%. So that is certainly not at all aligned with what we saw in the 1970s when we were seeing inflation 6, 7, 8, 9%. So right now, I'd say that we're still seeing somewhat muted, although higher inflation. Small businesses seeing a lot of problems in terms of supplier delays. So domestic supplier delays, foreign supplier delays, difficulty locating alternative domestic suppliers. This data is from a great report. It's a small business pulse that is released by the census every week. And so you get lots of information in there from what small businesses are saying. And so clearly, even at this point still, we're seeing a lot of delays in getting supplies. And that's not too surprising given all of the strength in the economy right now and the fact that COVID is still impacting a lot of manufacturing, shipping, and all those types of things. So, how are we diagnosing the problem right now? It's helpful to go back to Eco 101. And so what we had was a huge surge in stimulus, both fiscal and monetary stimulus, that shifted demand pretty much at this point, back to where we were pre-COVID. But the problem is, at the same time, we've seen labor shortages and bottlenecks. So, right now we're seeing rising demand, but also constrained supply. What comes out of that? Higher inflation, of course. So what does it look like going forward, though, is the big question. And I think going forward, demand could stay shifted to where it is, although there could be some downward pressure on demand just coming from the fact that a lot of the demand shift came from fiscal and monetary stimulus, which will start easing up. On the supply side, everybody's working on trying to ungum the bottlenecks. And even today, there are reports about places like Walmart shifting to 24-hour-a-day shipping, and the Port of Los Angeles doing the same. So trying to clear these supply constraints, which should ease inflation pressures. Wage growth inflation. So this is always a big factor if we're going to get a bigger inflation. It's a double-edged sword. Everyone likes higher wages, but higher wages will also have the impact of raising overall inflation pressures. If they are not also part of productivity gains. So wage pressures having not to do with the fact that employees are becoming more productive, it's just that their prices are rising, essentially. Up to now, the inflation actually, despite what we see in the press, it's actually still quite muted on wages. A lot of the wage growth we're seeing up to now is in the lower skilled jobs. So you can see by this chart, this data is brought to us by the Atlanta Federal Reserve, where they look at wages by education. And so you can see actually that the wage growth that's highest up to now is really in those lower skilled jobs, and that other wages, for the most part, still kind of muted, actually. It's somewhat surprising to see, especially at the low end, such strong wage growth, because normally when we see such strong wage growth, it's in turn from tightness in the labor market, right? So you see very low unemployment rates, you see higher wage gains because of supply and demand. Actually, right now, if you just look at the data, it would suggest that we still have some very big gaps in the labor market. So if you look at that bottom line there, that is the employment population ratio for people who just have a high school education. You can see that the level of people in the labor market is much lower than who are employed, is much lower than where we were pre-pandemic. So you would say, oh, there's a lot of people out there who don't have jobs. That should be more supply bidding down wages. The issue right now, and as we all know, is that yes, there are a lot of people who are not employed. Where are they? Why aren't they coming back to the jobs? Some of the answer could certainly be that there was so much fiscal stimulus, so pockets are still somewhat bloated from the cash that has been received. So they still don't have to work. Labor markets are tough, and there never is one answer. There's a whole host of reasons why it could take a long time for the labor market really to essentially clear out again, so that we're into more of like an equilibrium in the labor market. But whatever you read, there's probably some truth in it, but the truth in general is going to be much more complex than any one or two factors. In terms of just looking back to the 70s, this is one of my favorite indicators to understand how headline or underlying inflation is. The Atlanta Fed puts this together too. They put together a lot of great data, by the way, the Atlanta Federal Reserve. They break out inflation between flexible and sticky prices. And flexible prices are prices that adjust quickly, so like month to month, week to week, versus sticky prices are ones where the producers don't have the ability to change prices all the time. Maybe they only change them every 3 months, 6 months or so. So those sticky prices are going to have much more of an eye towards expected inflation and trying to recoup underlying pressures that are expected to happen. So as we see from the sticky inflation. Right now we're still seeing somewhat elevated inflation versus where we were pre-pandemic, but nothing like what we're seeing on the flexible side. So if this happens where you start to see sticky price inflation rising, that's a signal that inflation is becoming more entrenched. And that would be more like the 1970s, where we did have that more entrenched inflation. But up to now, certainly not the case. There's been a lot of fiscal stimulus. So now thinking about the demand side and what's going on there. So this is a chart of personal income, and personal income includes all sources of income. So not just wages and salaries, but transfers from the federal government. We've just seen, because of all the transfers through checks directly to the household sector, somewhat unemployment insurance, other things, a huge surge in personal income, actually much higher than what we were on, the trend that we were on pre-pandemic. So in effect, the pandemic was very stimulative to households. And we just had a surge in personal income. So there's a lot of bloated pocketbooks out there, and despite the pandemic. So that's one of the things that's happening too. We've just seen such a surge in demand from the household sector. And with that, just the inability for suppliers to keep up because of that supply shift. But going forward now, I think we're getting to more of like a baseline economy where we have less of these surges in household demand coming from the government supplying cash. And so we're going to be more probably back to that trend on personal income. So that should ease some of these inflation pressures going forward. In terms of GDP, because of all the fiscal stimulus, but also now as we have what I like to call the baton handoff from the government to the private sector, and more wage growth and more employment growth, we're actually back to GDP being at its trend. And this is, I'm just looking at New Jersey here. So that's a very good sign for the economy, that even as the fiscal stimulus starts to ease back, we're now back on our trend for GDP. So it suggests that the baton has been handed from the government to the private sector. And now we have an economy that can really grow organically on its own without so much assistance. So that's a very positive indicator to me. Another positive indicator is that GDP has grown, but without as much employment. So that black line is actually the employment level indexed. And so we're still quite a bit below unemployment where we were pre-pandemic, about 6% below the level. But GDP has rebounded to where it was pre-pandemic, which means that GDP per person has really surged. That's that blue line. That's a lot of productivity growth. That's very good for the economy to see that we've shifted to this much more productive type of an economy here in New Jersey. It's pretty much true throughout the United States. So what does that say going forward? I mean, will these people who are still on the sidelines, will their services be demanded? Well, clearly their services are still being demanded. There's a lot of help wanted out there. But having higher productivity growth, that's wealth creation for the economy. So that's a very positive sign that that COVID, as many negative effects that it had, it's transitioned the economy to a much more productive style economy. Here's wage and salary disbursements per employee. So you see this huge shift in the amount of income going to per employee. Some of that is a factor of the fact that a lot of the people who are still out of the labor market were some low wage, low skilled jobs. Unfortunately, for that part of the economy, we're still seeing employment tremendously below where it was pre-pandemic. So you have so many people out there who are lower wage, lower skill, still not back in the labor force. And the conundrum, of course, is there's supposedly lots of jobs out there for them. It could just take time for that all to clear. The good news is that the jobs seem to be out there wanting them. The other part is that, look, given that we've had some higher inflation, even though wages per person has jumped, in real terms, it's actually been kind of steady for the past 4 quarters or so. So inflation eating away at some of the most recent gains. So that's a bit of a negative, but just seeing this incredible surge in productivity per person is a very positive thing. Another nice thing here in New Jersey is that we seem to be gaining share of the Northeast economy. I count the Northeast as Pennsylvania, New York, Connecticut, Massachusetts, Maryland, Rhode Island, so that block. And this is a chart of looking at wage and salaries going to New Jersey workers as a share of all Northeast workers' salaries. And so we were on a downtrend for a long time here in New Jersey. And now things have started to not only baseline and trough, but start to pick up. So it looks like New Jersey's punching above its weight a little bit right now, finally, which is a great sign. Lots of applications for starting new businesses here in New Jersey. So this is looking at the level of applications per month, and then the green line is the 12-month moving average. Pre-pandemic, we were seeing about 3,000 applications per month. Since the pandemic, that number has grown to 4,000 per month. That's a lot of productivity. That's a lot of innovation, creation of new businesses. So that's also a very positive sign for the current and future outlook for New Jersey's economy. Not only that, but once again, punching above our weight versus the rest of the Northeast. This is indexed to 2019, looking what the rest of the Northeast has done. And it's been growing strong throughout the Northeast, but here we're still even punching above our weight, seeing growth of 5% above what the rest of the Northeast is going. So looking good for New Jersey. Another positive trend, venture capital flows into New Jersey have surged over the past couple of years. That blue line is just looking at the dollar flow, the venture capital flow on a 4-quarter moving average, a 4-quarter sum, excuse me. So that's grown from where we were pre-pandemic, let's say about $800 million to now about $2.4 billion over the past 4-quarter sum. And our share of the Northeast also commensurately rising from about 2% to about 4 or 5% of the Northeast share. So a lot of venture capital, also a very positive trend. This looks at the changes in shares of GDP. So what industries are adding to the overall basket of GDP? And what we see is for the past 12, 13 years, a big shift higher to higher value added industries that have higher wages and salaries per person, just create more value. Information, professional science and technical, management, some areas that have really surged in terms of their shares of GDP. A very positive thing is that we're much lighter on government share of GDP. Government, so looking at state and local essentially in terms of what GDP is, has contracted quite a bit. So we all love government, of course. I work for the government, so I don't want to speak badly of the government, but it is a very positive thing for the production and the productivity of the economy to see government step back and become more of a private sector focused economy. Also, again, a trend that we've seen throughout the Northeast, but New Jersey has punched over its weight on that one as well. Since COVID, what does this look like? The other area that's really picked up is manufacturing. So manufacturing has gained about 0.5% in terms of its share of GDP since COVID. Strangely enough, and maybe not strangely, transportation and warehousing has dropped quite a bit. Some of that is transportation. So, you're thinking Amtrak and New Jersey Transit and that kind of stuff. But given all the demand for goods, you expect that warehousing would probably be doing better than that data suggests. And a lot of it's probably on the transportation side. Healthcare and social assistance, as well as accommodation and food services, still below where we were pre-pandemic. But once again, the positive is that some very high value added areas of the economy have picked up their shares. Now looking a little bit at sort of like the future. So a lot of talk about blockchain out there, usually in terms of course, our coins, and tokens and things like that. But blockchain has a much more important role to play in the economy going forward. It promises to revolutionize the way we do contracts into a decentralized process. And if there's an industry that could benefit from that, it's certainly on the trade side. So here in New Jersey, trade is a big focus, of course, given our ports. So here's just a story you could look up if you Probably some of you already know about this, but, IBM and Maersk working together on a blockchain shipping solution would be tremendous to help what has been historically a very tough area of the economy to control and understand where everything is at the same time. A surge in automation. So I say no workers, no problem. This is a picture of something called the burger maker, which is basically a machine that creates hamburgers from scratch. So no workers, well, we got machines to fix that for better or for worse, but that's a future thing. Alternative energy, of course, here in New Jersey, there's an aim to be carbon neutral by 2050. Of course, we have our new wind port being developed in the south of the state. So of course, another area of innovation. And then changes in the workforce, something that's a big discussion point. This map shows the share of jobs that can be done in the states. As you can see in New Jersey, we have some of the highest concentration of work that can be done from home. Positives and negatives from that. The positives is that our workforce can now have access to the global economy, essentially. And so that should be very positive for the income raising ability of our workforce. Very solid thing for New Jersey. So that's my presentation. So I hope that you enjoyed it. Hope you saw all the innovation that we're seeing in New Jersey and all the positive elements. So some risk short term, but I really think that we're seeing a transition to a very high value-added economy here in New Jersey with a lot of opportunities. If you have any questions, please email me at this address. And thank you very much for listening.
Thank you, Richard. That was really informative and a good lead off for the rest of the presentations today. We're now going to move into technology and begin with Braxton Plummer, New Jersey Director, State and Local Government Affairs at Verizon. I'll come back when Braxton finishes. Braxton, it's all yours.
Thank you very much. That was a great presentation and a great lead into some of the things that Verizon and also the other carriers are working on. I have one of the things I wanted to mention. I know everyone hears about 5G, 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 and a lot of times it's attributed directly to cell phone. But believe it or not, the concept of 5G is actually attributed to what for on the business side for something that they call MEC, which is basically multi-access edge computing, which allows folks to almost have low latency and also to be more efficient. As many of us have been working directly in the space of working from home and also just in general of like dealing with major projects and major data, low latency, which basically is zero download times, is something that we really need. And I think from a multi-access edge computing piece, especially with 5G devices and things that are working a little bit more efficiently, technology is advancing. That's what makes it that much more important. I know for the most part, for MEC means for business, it means faster processing, increased bandwidth, and also MEC provides more tangible benefits to business. And I know most of us have to work, we're always working on a regular 24-hour schedule. And I think for us to be more efficient, it's key. I think also with working with Chip, I think there's going to be another opportunity to work with a lot more businesses to see how they can do more with their workforce, especially since folks have been working directly from this hybrid work environment. So a lot of the things people will ask, well, how does MEC and 5G, how can it change entire industries? I thought it was interesting, the reference to the burger maker in the last presentation, but the next generation isn't just worried about speed, and it's all about imagining what's possible. So in the manufacturing side, connected factory floors are becoming ways that are always on. MEC architecture, can improve floor safety, get machines communicating in near real time, and maintain zero touch quality assurance, which allows us to do more from further distances instead of necessarily just being directly in the offices. Also on the transportation side, businesses will be able to take advantage of a 24/7 autonomous fleet, and MEC with high bandwidth and low latency of 5G will process road and driving information in near real time, which is key, especially in municipalities when you have major storms or even with stateside resources, it's always important to have things that even if you can't get to a storm or even just to a major disaster, you can work from a distance, which allows us to be more efficient. And also, obviously, the biggest piece that everybody always focuses on is the entertainment. I know we've been working directly with the city, as also with Prudential, and we feel that when you have larger crowds, there's a lot of strain, not just on the mobile side, but also just regular day-to-day function. And with the upgrade of the 5th generation or 5G and MEC, it allows things to be that much more important and also that much more enjoyable, especially when you have virtual museums that are coming more about now in this pandemic space. So I would also think, since I know NJIT is on the call as well, I think what's really interesting, I know as a company from Verizon and also the carriers have been working, MEC is also something that can enhance and also further develop the smart communities, smart cities projects that I know we've been working on. I know part of the things that we've been working with the city of Newark for the most part is also talking about how you can have, your water testers and places and things like that. And even just, I know recently they just finished the project with the issue with the lead, but I think that now moving forward, something like 5G and also MEC can allow you to use the technology to kind of sense things in advance, kind of move forward with a lot of the bigger issues without necessarily having to worry about the strain of, finding out things too late. You can find out things in real time. So I'd love to discuss further at another note or maybe in another conversation if anyone has any additional conversations or questions in regards to 5G and also MEC moving things forward in the future. Thank you so much, Barbara.
Thank you, Braxton. Really fascinating to hear how much 5G is a factor in many, many other processes and things about the way that we live. Thank you for that. It's now my pleasure to turn to Michael Ehrlich. Michael is at the NJIT Martin Tuckman School of Management. He's an associate professor and director of the Lair Research Institute. Michael, it's up to you.
Thank you very much, Barbara. Braxton, that was a great lead-in. So as we all know, technology and innovation are great. There's really no question. Certainly they drive job growth. Kauffman Foundation talked about startups driving job growth, productivity growth. Richard just showed us the performance of productivity growth, great things, and just overall economic growth, really come from the fact that we're doing things differently and better. My conversation here today actually is really going to focus on the other side, though, a little bit. We're going to talk a little bit about some of the unintended consequences of technology and financial innovation. And I'm going to focus on two of them, although there's some more that we could actually potentially raise. The first one is this thing known as Schumpeterian competition. So Joseph Schumpeter basically pointed out that that when there's growth and we're making technological change, we're in a process known as creative destruction. Creative destruction means as we're creating something new, we're kind of getting rid of something old. And so there's a long track record of this. We point to many, many examples. I'll just point to two simple ones. One is there used to be lots of little independent toy stores. And of course, Toys R Us basically kind of put them out of business by having kind of economies of scale and lots more toys and lowering prices. And of course, Toys R Us themselves was put out of business by Walmart and then ultimately by Amazon, who basically made it even more convenient to buy toys. And so Toys R Us went out of business too. There used to be a whole lot of little independent video stores or bookstores. And of course, we've seen, Blockbuster or Amazon kind of took those out. And then of course, Blockbuster itself got taken out by innovations from Netflix and others as well. We're seeing a lot more of this now, this rapid innovation that Richard pointed to. We're seeing, things like taxi and truck transport. When you add in machine learning and some new technology, we're going to get self-driving, and it's going to happen. I don't know exactly when, but it's not so far away. And self-driving is going to lead to a whole lot of creative destruction. There's going to be consequences for the job market, and we need to think now about what we're going to do then, as we see potentially cars, trucks driving themselves, and then where are the jobs for all those people that used to have those jobs. place I really want to focus, though, is on financial bubbles. Financial bubbles has been much in the news. The Lair Research Institute, we have a Lair Bubble Center. We've been looking at these financial bubbles for years. And there's a standard pattern for these financial bubbles. The standard pattern is that there's an innovation. Smart people invest in that innovation very rapidly. They take positions in, again, go back to sort of like internet and all these other things. They make investments in those, and then people who are a little less sophisticated see these things going up and hear about some of these markets. They then start to invest in these markets as well, but they really don't know as much about these markets. They're more prone to mispricing. They get overenthused, a little bit euphoric. They drive prices too high. The smart guys kind of take their money out, saying, well, okay, time to take our money out. And then something happens to sort of scare or alert the less sophisticated investors that they really don't know necessarily what they're investing in. And of course, we see a rapid mispricing and a rapid correction, which we know is a collapse of a bubble. We've seen this many, many times. I mean, of course, we've seen this with subprime mortgages, which was important innovation, but of course, led to overpricing in real estate. The internet bubble of 2000. It goes way, way back. The railroads used to have a bubble. It goes actually back 400 years. The earliest documented bubble was the tulip mania in Dutch tulip mania. And so this pattern of overenthusiasm and innovations driving growth, but then driving overenthusiasm, mispricing, and then a collapse. So the big question I guess you might be asking is, are we in a bubble now? And I'll just tell you right away, it's easy. Yes, we are unambiguously in a bubble right now. There are lots of indicators that we're in a bubble. Those indicators generally are things like lower contractual burdens, less legal restraints on getting started. So you're looking at things like SPACs, which basically have made it much easier to have an IPO. You no longer need to file this extensive S1 document with the SEC. You can just kind of back your way into a online public company. They're also looking at things like credit spreads. We look at sort of how people price risk in the future. And right now, those credit spreads have been collapsed to very low levels. People are basically building in low expectations of future risk. So yes, we're in a bubble, but the wicked hard problem is to know, when is it going to pop? And in fact, there I have less good information to give to you. It could be tomorrow, could be a couple of years. And it's going to really depend upon a lot of things. It's going to depend on what the government does. If the government continues to stimulate the economy with large infrastructure type bills, that's going to continue to support the economy, potentially continue to support what we're seeing as mispricings right now. If those were not to happen, if people were to get nervous, the bubble could pop actually quite soon. And so it's really hard to know. It could be, again, tomorrow or 2 years. I wish I could give you more information about that. Looking more specifically at some of the things that we're observing in the market now, Richard talked a little bit about blockchain. Blockchain is a fantastic innovation, but in the tradition of sort of all other bubbles, it's almost certainly led to investment and leading to overinvestment, at least in some sectors of cryptocurrency or non-fungible tokens. And so what we're seeing is that there's almost certainly a bubble in some parts of the economy. We're seeing probably a bubble in startups. Again, we talked earlier about SPACs. We're seeing a lot of money going into private equity. But of course, that is actually not only part of the solution, but it's also, as I said, talking about unintended consequences, part of the problem. And so here we have probably the part of the bubble that I'm most worried about is risky debt. It's complicated, but if people are investing in cryptocurrencies or startups, they may be in a bubble, but at least they know that they're investing in something risky. And people investing in crypto know that they're investing in something risky and hopefully are not investing more than they can fundamentally afford to lose. True also for startups or SPACs or early stage companies. But for risky debt, I am afraid that people may be investing in risky debt without knowing it. So mutual funds who are putting together portfolios of debt are trying to compete with each other to provide a higher yield and gain customers, market share. They may be investing in risky debt issued by private equity firms or by higher risk sovereign debt. And of course, those types of debt are going to be embedded within these larger mutual funds, or people are going to be investing without really knowing how much risk they're taking. And that's where I'm really worried about, where the bubble popping and people who don't understand they're taking the risk are going to get potentially hurt. So I think there are some unintended consequences that we need to be prepared for. Tech is great, but we need to keep an eye out for these unintended consequences. I'm going to pass it back to you, Barbara. Thank you.
Thank you, Michael. I find that fascinating, that the whole, especially the last part about the financial bubble. And I remember reading about the value of tulips having gone way up. And it's really an interesting science. Now I'm pleased to turn to Simon Ninans. He's with he's CEO of the New Jersey Innovation Institute. They are a part of NJIT, but they really do some very separate and phenomenal work. Simon?
Thank you for having me. Excited to talk about what do we do to support the growth in Newark and in the greater New Jersey area. What does NJI and what does NJIT do to support all the people on the front line? And lately, a lot of business owners have told me that they feel a little bit like the Red Queen in Alice in Wonderland. Alice in Wonderland sees the Red Queen and she says, "You're moving fast, but you're not going anywhere. Why is that?" And the Queen says, "In my land, it takes a lot of running just to stay in the same place." And a lot of people feel that way. So what are we doing to support growth and to move forward? Because as you've heard, there's a lot of uncertainty. A bubble might be here, might not be here. What do? Do I invest in workers? Do I expand in technology? Computer chips are very expensive right away. We do expect those to come down, by the way. And as you heard, the supply chain to normalize a little bit. So if I were to make big investments in technology, I would probably wait a little bit. But besides that, what do we do as institutions to spur economic growth? So one thing that we're doing, I think, would be very practical for a lot of people here on this webinar, is a monthly coffee club. There's no speaker, there's just good coffee, good tea. I'm a tea drinker, good tea, bagels as well. And we just connect venture capitalists, professors, faculty, students, startup, community members, and let them interact with each other. And with that, we try to build a critical mass. We need new companies and we need to support those. So we have programming in place for startup companies. Feel free to stop by at VentureLink in Warren Street, Newark, every first Wednesday of the month, and it's at venturelink.org. Second, NJIT has long supported the entrepreneurial ecosystem within New Jersey. We've taken an additional step towards truly supporting startup companies. So we are in the process of launching the NJIT Venture Fund. And with that fund, we make 70 investments up to $75,000 in brand new startup companies. Those companies have to have a link to NJIT in some sort of fashion. Either a founder is an alumni of NJIT, or it's a faculty member, or a student, or somebody who licenses the IP from NJIT. You've also seen this morning, just came out, that Newark Venture Partners closed its second round at $85 million. Hacks Accelerator is basing their headquarters in Newark, which is a very big step. There were a lot of states competing to attract Hacks Accelerator. It's a hardware-based accelerator. It's coming to Newark. These are all very good things for Newark and the greater New Jersey area. There's a lot of growth in high-end industries, such as our cell and gene centers. One of our divisions at the New Jersey Innovation Institute focuses on cell and gene focused research and manufacturing of the next wave of medication. So there's a lot of growth in there, but it's not just in those sectors. There's a lot of growth in the restaurant business, in delivery services, all kinds of sectors. Focusing and nurturing that growth, though, in the high industry sectors, we've focused on very practical certificates. Not everybody wants to go to college for another 4 years to get their degree. So we've now focused on building out our non-credit certificates that are very practical. There's a couple of programs that we have that basically guarantee you a job after you finish the program. Two prime examples of that is cybersecurity program. It's about a 9-month program. It costs a little bit under $20,000. The cool thing is they almost guarantee you a job. 98% of the people who have that certificate enroll and get a job right away. Digital marketing is another example of a certificate that you can use and obtain in a short term and right away move into the work field. So with that said, I'd like to say reach out to us any way we can help. I wish you all the best, and better times are around the corner. And again, thank you for having me. Back to you, Barbara.
Thank you, Simon. So a lot of innovation going on at NJII. I encourage you to follow up with Simon and learn more about the different businesses that are being fostered and the different types of companies that are growing in Newark. There have been some recent announcements, I think, that build on the technology hub in Newark, and NJIT is certainly something that draws the technology companies to Newark. We're now going to turn to small business, and I'm delighted to welcome Kelly Brasna, who is the CEO and State Director of the New Jersey Small Business Development Center. Kelly.
Great. Thank you so much for having me here today and being part of this forum. It's very exciting. One of the things that I want to talk a little bit about is the New Jersey Small Business Development Center Network, and actually what we do and how we have addressed all of the turmoil that's been going on since COVID has hit New Jersey, and quite honestly hit pretty hard. So the New Jersey Small Business Development Center is a public-private partnership. We get federal funds, we get state funds, community funds, and our host is Rutgers University, Rutgers Business School. And so we cover the entire state of New Jersey, and we provide no-cost consulting, any business consulting, whether it's startup, whether it's growth, whether it's technology, whatever it may be, and also low-cost and no-cost training programs. One of the things I want to talk about today, though, is that we put all of our programming together based on data. And we've been listening to a lot of data here today. And I want to add just a little bit more, because we have done three series of surveys with small businesses on what their needs are to make sure that we put the right talent in place to address the needs of small businesses and overcome, obviously, what's been going on. We partnered with Rutgers Business School in the Ehrlich Center to do these surveys, and we did it through the Affordable Care Act. We had some grant funds, and we were able to survey in the beginning of COVID, in the June timeframe of 2020. We did another one in November of 2020, and we just finished up a third survey. We were hoping it was going to be sort of the beginning, the middle, and the end of addressing the turmoil, but unfortunately, this is going to linger on for a little bit longer. But one of the results I wanted to just talk about these surveys, and from the beginning, obviously, the businesses were really concerned about how to address the safety needs and how to make sure that we're handling the people coming in and keeping the customers safe, but also keeping the employees safe. So a lot of what they dealt with in the very beginning was how to reconfigure their space and information and knowledge on that safety regulations to ensure that that was taken care of. In November, when we did the next survey that came out in November, that wasn't quite as much of an issue, but it was more along the line of how do we address the decrease in consumer demand? How do we increase the lack of customers that are coming in, and looking at hybrid models, brick and mortar, transitioning them to virtual. And quite honestly, we pivoted quite a bit into working with helping businesses to do that pivot, to actually address those changes. And if you were purely brick and mortar, did not have a virtual presence, whether it was a restaurant to do takeout and take orders online, things like that, you maybe were going to be out of business if you didn't address those needs. The final survey that came out, we truly saw a little bit of the changes that came through, and more along the line of the workforce needs, right? Of how do you get your workers to come back? You know, there's a lot of struggles with businesses not able to bring people on board, but we really did work at that survey. Really, the results came back was really about the employee base of things. I want to just make sure too that 39% of the survey results was really about technology and really how to replace or assist with technology. 31% of the businesses surveyed said that they actually did training for their employees on technology. 66% of the businesses that were surveyed needed financial credit assistance, things like that. 57%, again, finding workers to replace the vacancies that were in there. And in about 55%, we're looking at the future and looking at, how do they remain relevant in there. So 68% of those businesses that we surveyed were women and minority owned businesses. And, that was really exciting for us, because obviously we want to make sure that we're addressing diversity, equity, and inclusion, to make sure that we're addressing all the needs of all populations that we're serving. And again, as I mentioned, 68% were the minority owned businesses. So what did we do with that information? What we did was we put together so the 3 or 4 things that continued to bubble up from all 3 of the surveys was access to capital, cybersecurity, e-commerce, and of course, the last one was really the labor shortages, how to address those labor shortages. So that was sort of the theme throughout all of the surveys that we did. And what did we do to address those needs? Well, we put together a capital team that specifically just to help businesses access capital, whatever that capital may be, PPP, EIDL, business loans, whatever that might be. We have individuals that are business brokers, business bankers, CPAs that really came on board, and in 8 out of the 9 of them are bilingual. So we wanted to make sure, again, that we address the needs of all communities. And we hired community members to serve the community. So we wanted to make sure we mirrored our client base. We put e-commerce training together. And of course, if you have e-commerce, you have to address cybersecurity. So they sort of come hand in hand. So we put some talent and some webinars and some trainings together specific on the cybersecurity aspects of things, because people need to be aware. If you're virtual, you're international, and therefore you need to worry about, especially if you're taking funds online, through PayPal or whatever it may be, Eventbrite, you need to make sure that you're taking care of all of those security issues. So we have partnered quite a bit with a lot of different organizations as well. We're all about collaborating and all about working with each other. So we like to be sort of the hub of the resource. Come to us, we'll evaluate your business, holistically look inside and outside. And by the way, we also address mental health. And that was something that was a little bit more unique, and we're still doing that today. How to deal with anxiety and stress of all that's going on. Businesses and struggles, whether you have loved ones that you lost or were sick, or also people that you couldn't even come in or afraid to come in because of anxiety and stress and things like that. So we wanted to make sure that we're addressing holistically inside as well as outside of the business and what those needs are. And as a result, we did 1,400 events, 26,000 attendees, 57,000 total hours that we worked with the businesses. And we truly did help a lot of those businesses. So I know my time is short. Thank you so much. I appreciate it. But know that NJSBDC is here to help you. And we are here to help all businesses, whatever stage you might be. Thanks.
Thank you very much, Kelly. That was terrific, and good to know all the work that you're doing at the center. Next is Vanessa Keano. She's Senior Vice President of Business Development at Invest Newark. After Vanessa speaks, she's going to have to leave. So if there are any questions, we'll direct them to her after the program. Vanessa, it's all yours.
Thank you, Barbara, and thank you, Kelly, for all that vital information that the NJSBDC collected. At Invest Newark, we're here to propel and advance economic development for all Newarkers. And we do so with a dedicated team of planners, investment professionals, and innovators, as we've been talking about innovation and technology on this call. I really wanted to address some of the items that Kelly discussed regarding the downturn, and even what Richard shared earlier. In Newark, during the COVID pandemic, many of our small businesses were impacted. And as you go through the city of Newark, if you're downtown, the majority of our small businesses downtown were impacted due to the lack of the workforce. many of our anchor businesses have yet to return to the workplace. So that affected many of the businesses around Prudential, Mars, Panasonic, PSE&G, Horizon. And these were the small businesses that provided dry cleaning services, coffee, pizza, delis. And, with that downturn at Invest Newark, we tried to help them with applying for all the financial assistance that was available. At Invest Newark, we teamed up with Audible and Newark Venture Partners last year to grow our team so that we can best provide additional assistance to businesses. And one of the things we found that was most difficult for small businesses was their financial documentation. They just didn't have it available to them at home, primarily because they didn't have their technology, either the work laptop or business desktop at home with them. Also, their immediate contacts and services, accounting and bookkeeping, were unreachable because no one was in the office. So that shift onto working at home and being available to provide services was something that affected the small businesses. And luckily for our food businesses, they were able to shift readily because of certain delivery services that are online that were already at their fingertips, but those come at a cost. So it was important that we support the small businesses with the financial assistance they need to get them the technology they need. Regarding emerging businesses, some businesses shut down, but some started up. This gave some entrepreneurs the opportunity to focus on their side hustle, so to speak. And if they were more in tune to technology and were already creating their brand and online presence on social media, they got a jump start on some brick and mortar businesses that weren't that attuned to their technology and social media. So in the neighborhoods, outside of downtown, businesses were actually flourishing because people returned home. So, the shift of where the spend went back to people around people's homes. So there was, as much as it seemed like there was a downturn downtown, it was still, there was still businesses that were actually flourishing during the pandemic. And regarding entrepreneurs, some of our co-working spaces also flourished because people needed a place to work besides at home, because they were running a business and realized, well, now the kids are at home, my partner is at home, I need to focus on my business. So places like Equal Space and Makerhoods have grown and are growing. I just want to focus back on the technical assistance or all the services that Invest Newark provided. We also provide additional marketing to businesses. So last year, we started our business Newark, which was a huge marketing campaign to draw people to shop at local Newark businesses. That was run early in November last year. Excuse me. And we'll probably be, we're working with the businesses that propelled that to bring that back to have people shop locally again. Also, we hosted Newark Restaurant Week this summer. As with the summer weather, outdoor cafes were wide open, so we wanted to ensure that we bring people back to Newark, come to our eateries. So many eateries opened outdoor seating that they didn't have before. So again, the pandemic brought some actual opportunities to businesses, and businesses were able to leverage that. Last two things I want to bring up is that Invest Newark, we partnered with Equal Space to bring about Small Business Week. That'll be in November. During that week, we'll have events from financing to customer building to social media and marketing. So we will also be having Invest Newark's, we're bringing back our Diversity Certification Expo. Our expo will be held November 9th at the waterfront. where we're going to be bringing together our certifying agencies. These agencies will work one-on-one with businesses to get their diversity certification. And that, those include not just the state, but Port Authority, New Jersey Transit. This way it gives businesses the opportunity to grow their businesses and apply for contracts and opportunities, not just with those agencies, but also with our larger organizations in the state and out of state. And also, speaking of technology, in December, we are hosting, we'll be partnering also with Equal Space for Newark Tech Week. This is now going to be, I believe, the 6th Tech Week. And during that week, we're going to be hosting a fiber optic expo, vendor expo at NJIT. And that expo is to bring about all the local and MWBE businesses that support the fiber optic industry. As most of you may be aware, or maybe not, that Invest Newark manages Newark Fiber. That's the homegrown high-speed internet service here in Newark. It's based on the city's dark fiber infrastructure. We currently offer gigabit and up to 10 gigabit internet connections in several buildings in Newark. We worked with Urban League of Essex County to connect their tech house, which they're going to be providing STEM education to local students. So to bring everything back together, this is a great opportunity to talk about businesses, but how technology was definitely a big part of how businesses succeeded last year. So I look forward to seeing you guys again later this year at our Tech Expo, and looking forward to talking more about the outlook of not just Newark, but all our businesses in the region.
Wonderful. Thank you, Vanessa. We really appreciate all that you shared with us today. We will be putting the information that the speakers share, the resources and their contact information into the thank you email. So please watch for that, because it's really been a wealth of information that's been shared today. We're now going to turn to our final topic of the day, which is real estate and construction. The speakers have agreed to a different format for this than in the previous presentations. Andrea Borelli from Savills will be leading off. Andrea Borelli is Corporate Managing Director, Workplace Strategy and Project Management at Savills. And then she'll be having a conversation with Mike Farrell, who is VP of Estimating and Purchasing at Structure Tone. So with that, Maya, I'll ask you to have both Andrea and Mike on camera to begin this conversation. Thank you.
Great. Thank you, Barbara. So my name is Andrea, and as Barbara mentioned, I am a member of Savills real estate team here in the United States. I'm based on the East Coast and work primarily up and down the East Coast in the New Jersey, Philadelphia, New York areas. My background, just a little bit about my background, I was in an interior design and corporate architecture firm for over 25 years prior to joining, and I've been at Savills for 10. And so my role is workplace strategist. I want to just explain what our role really is, because I think that the word trend is something that has been associated with workplace strategy. And it started, 15 years ago about how can we reduce costs, and ended or resulted in people being put into tinier and tinier spaces without much thought at that point being given as to what do those spaces need to do to support people to work. And so as the prior presenter had mentioned, so much shifted in the way that we worked during the pandemic. And that is now informing the upcoming trends, if you will, in the way that space is deployed for businesses across the country and across the globe. Some of the things that we are noticing are really kind of those same silver linings that organizations have figured out. If you can think about what happened back in March of 2020, everybody basically turned their light switches off and went home. There wasn't a choice. And they may or may not have succeeded immediately at making that work, but over the past year and a half have figured out ways to work remotely. and are now investigating what that means as they return to the workplace. And the metrics for returning to the workplace have really shifted. They shift with CDC recommendations, they shift with state regulations, they shift with individual organizations thinking about mandates and safety protocols and HR aspects. And so as we look at that, coming back to the office is not just flicking the switch back on, frankly, but we're all at different points along a dimmer switch about how ready we are to come back and what that looks like. And so Mike's group and others like him and I work together to implement those changes. I would say that the trends, so to speak, moving forward are really working to understand how does space best suit those users and what does it need to do for them. So while so many organizations are looking and taking surveys of their employees and asking, how frequently do you need to be in the office to do your job? And some of those responses are coming back and saying, never, once a month, twice a month, weekly, very rarely daily. We're recognizing that that's going to change forever. But if we talk more about what type of work people need to do, it really is about getting together and collaborating, and also being part of the fabric of something that we all lose in this virtual setting. And so the types of spaces that we are seeing deployed, while maybe there is an ability to shrink square footage to a degree, largely it is reorganizing it. So perhaps people don't have assigned workspaces. Perhaps they are sharing workspaces based on the hybrid nature of when they're in the office. We are seeing many more demands for conference and collaborative areas, amenities where people can come in and feel that there's a purpose or a reason to return to the office, whether it's that they need to collaborate and meet face-to-face, or they just want to be there. And so corporations are looking at what do they want to provide in the space that makes it a place that people want to go to. There are certainly aspects of working from home, whether it's childcare, elder care, commuting, returning to an office that's on the 50th floor in a metro area, that are considerations for folks, but offering that flexibility is key. And I think that that's probably one thing, Mike, that you're seeing as well in terms of the types of spaces are shifting, but perhaps not necessarily the square footage. And before I kind of turn it over, I'll also say we're seeing that costs are certainly escalating, and some of that, from my perspective on the project management side of implementing those design solutions, is because people are wanting higher end, nicer spaces to attract people to return to the office, in conjunction with the reasons that Mike is going to recognize are occurring and increasing costs across the board as well.
Agreed. Thanks, Andrea. Yeah, to comment on the types of spaces, at least that we're seeing come in to our office here in New Jersey, on the corporate side of things. I look after our estimating department here of about 20 people. So in the past year and a half, we've spent a lot of time doing that for clients, is running numbers and running schedules and looking at types of spaces as they try to adapt back to this, what is the new model going to be? And it's exactly the types of spaces we've seen come in here, Andrea, is they may, companies may not necessarily, at first you hear maybe they require a less footprint, but now we're seeing, well, maybe they're keeping the overall footprint, but allocating more dollars towards these amenity spaces, like you mentioned, more conferencing areas, more collaborative areas. When the folks do come back to work, they want them to stay there. They want to entice them to be there more than just a day or two a week, depending on the business. To your point, some businesses can adapt and work more remotely than others. Certain departments within certain businesses can do that too. We see that in our own business. So, it's first of all, I'd just like to also then take a step back and just thank you, Barbara, for being invited to this program today. I really enjoy attending these, and it's a privilege to be part of the panel. Everything that we've heard today to this point really does show up in the real estate and construction business, from Richard's opening remarks of supply chain and labor constraints to IT infrastructure spending that we're seeing, and then even this, I thought it was great, what Michael mentioned about creative destruction, where we're seeing in the commercial office space some Class A buildings in New Jersey being slated for demolition to put up distribution warehousing. So really hits home, and it's amazing to see how these trends hit this business. In addition to the commercial office space that you touched on, we're pretty busy in a bunch of other sectors as well, specifically healthcare, and also industrial. We're starting to really cut our teeth into, and of course, life sciences. Those are the three main, I'll say, sectors that are keeping us busy right now. We've got a little bit of interest with work going over at Newark Airport as well. Some of the larger financial clients, of course, in Newark that were mentioned earlier that we're happy to work for, and Prudential and Audible and even PSE&G are some of our important clients that are fairly active as well. So, but you touched on the supply chain, and that's been one of the biggest challenges for us. You know, logistically, we know those are big issues between the shipping constraints, and the ports are backed up. Even trucking and rail lines are providing challenges. The labor shortage is definitely something we've been working through in the last year, and it relates not only on job sites but in the supply chain. Financial strain has absolutely been a part of it. And some of the most highly impacted materials are the electronics. We heard earlier on chips and anything with lighting or any, audio-visual components specifically, HVAC equipment, roofing and insulation, steel, all of these things, metal studs, drywall have had significant price increases from the beginning of even just this year alone. 40 to 50% increases in material costs in those items just from the beginning of this year. Steel much higher, sometimes 300 to 400% from pre-COVID levels to now, not all just this year. So, we're also working very hard to just stay in close touch with our vendors and our suppliers. We got a lot smarter and learned a lot during COVID. We subcontract all of our work out. So we're the construction managers, the general contractors, we're the project managers, the estimators, the superintendents, the accountants. So to say we took for granted where all our supplies come is probably, maybe that's a little exaggerated, but we rely on a lot of our sub partners to let us know what's going on, and we had to get smarter. We had to work with them and trust them, and even get past them, let's say, to make sure our relationships were very strong with the suppliers of material. So, for folks like Andrea, we try to add value early on in the process to make sure that, we're informing a schedule and a budget, not only with the correct dollars, but lead times as well. Is this possible? Andrea, I don't know if you're seeing it, but we often will, communicate that information, and maybe we have to pivot to something that's maybe more domestically sourced, or, has a lesser lead time, less risk.
Well, I think that one of the items that Mike mentioned is a lead time now, are chips and the audiovisual products. And as we look at people reframing the workplace, any of those types of spaces that are not a one-for-one assignment of space, a seat for me, a seat for Mike, and then some conference rooms, they're shifting to other uses like activity-based workplace, where I might go into a space that's meant to accommodate 500 people, but it only has 100 seats. And the way that I'm going to do that is I'm going to reserve space based on, am I coming in to do heads down work? Am I coming in to collaborate with someone? Am I doing focused work, but on a computer where it's going to be loud and disturb people? They all require different types of space. But if I'm doing it on an as needed basis, I might be heavily relying on a reservation system. And those are based on the audiovisual systems. And while you might look at it and say, well, Mike's doing construction, it coordinates with everything that goes into that space. So some of those lead items that we typically might have said, you don't need that to occupy and work in your space. The use change is now saying you actually do need them. So it is having an impact on when people can utilize and occupy. The nature of where we are with the pandemic still not being something that everybody is comfortable with saying, we've got a hard fast, we're in 100% and we're all comfortable with it, means that it does afford Mike and myself in that project management role some wiggle room in terms of schedule to manage some of these lead times, because people can kind of pull back a little bit. The fact that we all know how to work remotely from home now helps with those scheduling issues. It just is not ideal, and I think we're all itching to get back to it. for sure. And then the other point, Mike, that you made, we're seeing lots of office buildings ask for those studies about, do we have the slab to slab height where we can put in lab space, life science uses that are not just administrative. So it also means that that market is getting tighter in certain areas where there might already be a crunch for commercial office space. And now it's being taken over not by corporations, but by pharma companies that need lab space in a market that they normally would not either invest in or take the actual space in. So that's been an interesting outcome as well.
Sure, and then to support that, you can see, what Thor Equities did at 95 Green Street earlier this year in Jersey City, converted, working on converting that entire building to lab space. We're seeing some landlords in the Princeton market do the same thing, where they've got vacant buildings and they're looking, they're running studies, which then, we're fortunate enough to be able to support them from the budgeting and scheduling and lead times aspect. All of this goes hand in hand if they're trying to understand, what the value and then the timing of their investment is going to return value for them. So, and those are typically, and you might be able to confirm it, what we hear is that's typically those leases are longer term. These companies are investing a lot more capital to put in those specialty mechanical systems for the lab spaces. So they're going to stick around a little bit longer, which can be attractive.
And that certainly has an impact on organizations that, depending on where they are with their lease term, and they're making these decisions on how do we move forward, whether or not they're looking for sublease space and looking for the perfect Goldilocks space that they can just move into. And it somewhat doesn't exist. There's always some type of change to really support a business. But it's, whether or not that duration immediately is just a couple of years or if they're looking at the longer term. And in closing, I'll in terms of the workplace, I'll say that we're seeing different types of space being engaged. We are seeing a lot of companies really embrace this as an opportunity to rethink what they are providing to their employees in terms of human resources and flexibility for work-life balance, because there have been some of those silver linings out of this pandemic in the way that they deploy space and how they can manage their real estate holdings. And I'll say Eisai Pharmaceutical is a client of ours that we worked with through the workplace and almost done with implementation, that we are looking at them taking a real step forward in understanding what do their employees want moving forward, how do they provide it to them in the midst of a pandemic. And it really informed the space, amenities, size of workspaces, and the overall environment that is conducive to people being as productive as possible and wanting to be there. So those are really, I think, the key trends moving forward, and they're going to be implemented in a variety of different ways as the market keeps changing.
I think if I could add in closing from our perspective on the marketplace right now, if I could give any advice to anybody out there who is working with clients or is an end user themselves, that get your project management team and your construction manager team involved early. There's so many unknowns and variables now where, as opposed to waiting till the design is totally complete to go out and then try to, solicit bids to get your project moving forward. Get your team in place early. With the right team, you can really plan out your project and really ensure the success of the project for sure. Thank you.
Great. Thank you both. That was a really, really good summation of everything that we talked about today, because it really shows that what's happening now is significant change, perhaps more rapid than at any other point that we've observed in recent decades, certainly, and maybe in a long time. That the pace of technology change has accelerated so much that we are able, if this crisis, if this pandemic had hit at a previous time, we might not have been as equipped to be able to adapt and to be able to shift the nature of the workplace. And what it really ties together, this was a good way to end today's conversation, because it really ties together all the other things that we talked about today, with technology, with small business. And this is really a good way to wrap up today's conversation. Tomorrow, we are going to be covering additional topics and give you a sense of what we're doing. Picking up on the whole conversation about supply chain and the depth to which it has impacted the entire economy, we're going to be hearing from Leslie Hirsch, who's at the New Jersey Department of Labor, on labor trends, and also from Jose Lozano, who will be talking from the perspective of Choose New Jersey about recruiting companies and building on strengths in the state, like what Andrea and Mike talked about with conversion to life sciences and lab space. And then we're taking on supply chain, so that'll pick up on a lot of what we've talked about today, banking and insurance, and finally, healthcare and health insurance. And I just want to invite all of our speakers to turn their cameras on so we can give a virtual round of applause to all of you for doing a fantastic job today. So I'll give my applause to all of you. And thank you to our audience, because without you, we would not have a program. So we're grateful to you. We hope that you'll join us tomorrow and also for other webinars that will be announced at NRBP. Thank you and a good day to all.